Welcome to today's webinar. Today's topic will be on retire with confidence and how to actually access your retirement readiness and investment strategies to actually help you earn long-term retirement income. So to introduce a little bit about myself, my name is Jason, right? And together I have here with me today is Melvin. So both of us, we're actually wealth advisors here at Syfe, and I think for me and Melvin personally, we're actually very excited to be able to speak about today's topic. It's a big topic, and we hope to be able to unpack a lot of the following content itself. So perhaps let's start off with a quick poll. Try to help us to understand a little bit about our audience. Who are we speaking with? So very simple. What is your age? And are you currently a Syfe client with us?
Looks like we have a very good spread of participants actually, between like 30 to 49.
And of course, there are a few younger ones as well, like 20 to 29. Right. I think personally 20 to 29 is definitely don't say that you're too young to start thinking about retirement. Okay. All right. So thanks for answering the poll questions. All right. We'll try to tailor some of the content towards you guys personally as well. All right. So perhaps I hand the time over to Melvin. He'll take us through the first part of the agenda.
Right. Thank you, Jason. So today's agenda is actually, of course, to cover retiring with confidence. So we'll cover the why, what, when, and how you guys can actually understand retirement. It's not supposed to scare you, but I think it's good to put things into perspective, actually, given right now state of the markets. Most people are actually worried. Because if you check around, most people are investing for a couple of reasons, right? You want that pot of gold, maybe to give you that reason to maybe leave your job earlier, maybe because you have been working so hard for so long, but get a bit disillusioned about what you're working so hard for, and whether you have actually enough to actually take a break, right? So for why is retirement planning important? So number one is actually career, right? Most of us are working and have been working for quite some time. And as we get older, right, after the initial, the pay or salary spurt that we get from the 30s to 40s, right, maybe we start to discover that maybe our career longevity is not as strong as before, right? So with greater degree of uncertainty, this is when we start to put things into perspective. Maybe we should plan a bit further, no longer living for the weekends or even for the next 5 years, right? And of course, the next point is family, right? Legacy is something that is actually very important, right? We can't just, or rather some of us can, but most of us have the reason to actually plan for our family as well, right? Even though we say that, at 65, I want that $1 million, but is that $1 million really all for ourselves or also for our next generation, right? Then the next point, lifestyle. As we get older, right, some things to ask ourselves is that, does the things that we need in life change, right? Do our wants and needs change? And is our current earnings or savings going to cater for the same level of expenditure next time, right? Lifestyle can change, but one thing you notice is that your earning power might start to decrease in time to come, right? And the fourth factor is inflation. I think inflation is something that most of us is feeling recently, if we have been following the markets, right, Jason? Inflation is something that all of us is looking at, and what the Feds have been doing recently with all the rate hikes. So inflation is more than certain in the long run, and our purchasing power with our savings might actually diminish in time. So this is why it's important to plan ahead, so that when we are at 65 or even 70 as what they might raise the retirement age to, that our savings isn't kind of eroded by the ongoing inflation. And of course, last point, life expectancy. I think with medical advances and improvements currently, most of us actually lead a relatively good quality of life here in Singapore. So as our life expectancy increase, right, the savings that we initially planned might be actually insufficient in time to come, right? And some of us like to rely on CPF, but if you look at the 3 plans, basic, standard, escalating, maybe you actually raise some eyebrows, like, is it truly enough to actually rely on it? But of course, we'll touch more on that later on, right? So maybe Jason can go to the next slide. Right, so putting things into perspective, right? Singaporeans' average life expectancy is about 83.66. And average life expectancy is expected, right, to reach 85.4 in 2040. So as you can imagine, medical advances improve, like lifespan will actually improve, right? And of course, inflation, as years pass, goods and services increase in price significantly. The cliche example is that chicken rice from that 10, 20 years ago, right? Currently, how much is it? And if you're back in CBD, you notice that, the price didn't exactly drop, right? It's actually more expensive than before. And on the right side, you can see that inflation versus the Singapore savings rate. Unfortunately, it's not the best chart, but you guys can see why it's actually important to actually start investing ahead. Right, next slide, Jason. Now, what is retirement planning? So retirement planning revolves around having that peace of mind. Most of us are busy with our careers in time to come, maybe with our family, or maybe even business owners, right? You start noticing that you don't exactly have much time to actually plan ahead. So what you want to do is actually start thinking about it now, lay the groundwork, and maybe with like a fund manager or so, right, you get to focus on what you have to focus on and leaving it to the rest of us, right? And of course, an important topic that I want to bring into perspective today is actually the income curve, right? I likely touched on it in the last slide. When you're in your 20s, 30s, and 40s, it feels like your pay is always increasing in time, right? And it's very easy to job hop around, maybe with that 10-20% bumper, especially right now in an employee's market, right? It feels like, we can almost go to our boss and say, hey boss, 20% or nothing, right? If your boss say no, it feels like you have another offer ready then. But you start noticing once you're in your 50s to 60s, that strength that you have, right, kind of diminishes. You can't just job hop, or even if you attend those interviews and whatnot, most likely than not, the compensation package offered to you is actually less than what you're currently holding, or the new company might be unwilling to take on you as an additional risk, right? You are going to draw a higher pay, but you're not sure whether you can contribute as much as a younger person per se, right? So this is something that you want to account for in your retirement planning. As you get older, your income stability starts to fall. Then next point will be saving ability, right? Many of us advance in age, making a greater pay, but we have to ask ourselves, are we still saving that same amount as we did in our 20s, right? Or, the lifestyle creep is something that we have touched on multiple times. So this is when you start making those money and start spending those money as well, right? Some ladies are, they like to talk about Chanel bags. Some guys like to talk about that new watch in the market, right? So this is some things to pay attention to, right? Envision a lifestyle that you might be leading after 65 during retirement compared to your current lifestyle now, right? Is your saving ability going to match up to that expenditure that you dream of, right? So this is actually explained in a realities versus expectation, right? If you're making $2,500 per month, can you exactly retire with $5,000 at 65 years old per month? Unlikely, right? So it's definitely something that you want to compare it back to your realities. So everything that you do today will define what you're going to receive 10, 20, 35 years later, right? Next slide, Jason. So for when is the time to plan, right? I would say now, although you might be in your 20s, but I still say now is the time to start thinking, right? So for example, compounding ability, which most financial advisors, most investments experts talk about. Compounding is something that you only get with the privilege of time, right? Imagine at 60, right? You have less time towards 65 compared to someone being at 25, right? 25 years old, you have 40 years to compound. Even the range of investments that you can pick up on feels kind of wide compared to somebody at 60 who might have to take on a lower risk investment, right, due to the lower time horizon, right? So why now as well? Because it's far better to inculcate the right habits as early as possible, right? They say you can't teach an old dog new tricks, right? So certain spending habits that you inculcate when you're young might actually transfer to when you're old. And not saying that it's wrong, right? It's good to enjoy life, but maybe we need to come back to reality a bit, right? And of course, the ability to pivot and realign when you still can. Imagine somebody making changes to their portfolio at 60 years old and again at 25 years old. The 25-year-old is going to have far more options compared to the 60-year-old, right? And for how to retire with confidence, I'll actually pass this section on to Jason.
Thanks, Melvin. Yeah, I totally agree with what you just mentioned, actually. In fact, compounding interest is, after all, the eighth wonder of the world, right? Right. So in the next part over here, we're going to be talking about how to actually go into planning for your retirement. I think one very generalized idea here is that the figures and the data that we share, they cater to majority of the audience itself. But with regards to your specific financial situation, and I think that's where we have a little bit more personalization that you have to include in your planning, right? So we'll be going through these three steps: essentials and expenses, retirement in Singapore. We'll be touching a little bit on CPF Life, and of course, later on, Melvin and I will be sharing with regards to three case studies that I think would be very relevant to most people here in Singapore, right? So the next part itself is the essentials, right? So what do you need to have in place before you look at starting your retirement planning, right? And I like to suggest that there are these two essential factors, one of which is the emergency fund, right? And the second of it is the insurance. So emergency fund, I think most advisors or most investment experts out there, they usually espouse 3 to 6 months of so-called rainy day savings. And this is based on, of course, data that they have looked at. And I like to add in one more supplement to this is you also have to look in terms of your financial responsibilities and dependence. So a quick example here would be, for example, if you have, let's say, 4 young children that you have to care for, let's say you have elderly parents that you also have to care for, right? Obviously, it's going to be very different compared to, let's say, a single bachelor at 45 years old. Right, so this emergency fund, 3 to 6 months, yes, it is. Take it as a very general figure itself, but you also have to look into your own personal situation. If you find that you have more dependents, then 6 months may actually not be enough for you. All right. And the second point here is the insurance aspect. And I think I don't think I'm going down the route of trying to scare you or anything like that, but rather what I'm trying to point out here is that insurance comes into place as a very good protection against unexpected shocks, right? So take, for example, health insurance. As we all know, in Singapore, there's this very common saying, you can die in Singapore, no problem, but you cannot fall sick in Singapore because it's very expensive, right? I actually pull out some figures. We talk about late stage cancer here in Singapore. The expenses could go up to like 8,000 to 16,000 per month. All right. To me, that's a lot. And no matter how much funds in my savings account I have, it is going to be wiped out pretty quickly. Right. So I think that's where health insurance comes in as well, where you protect your portfolio against such unexpected illnesses or injuries, so on and so forth. Right. And of course, life insurance also comes in where, like I mentioned earlier, you have all the dependents that is relying on you, and especially so if you are a sole breadwinner of the family. Right? I don't think any one of us would like to be in a situation where something unexpected happens and you don't have adequate health insurance, or you don't have adequate life insurance, and that's where you have to start worrying unnecessarily about what a big medical bill that you're getting, or what a huge expense that you're going to have to cover in the next few years itself, right? So like I said, bringing back to the point, the two essentials before you start retirement planning: your emergency fund and your insurance, right? Get these two into place, because these two, I would say, are the basic building blocks. And if let's say you're into physics or construction, you know that the foundation of the building, if your foundation is strong, you will be able to build a taller building itself, right? And of course, when it comes to retirement planning, other than just getting the fundamentals right, you have to set a goal. And I think on a very psychological basis, setting a goal would assist you a lot in trying to imagine what 20 or 30 years is going to look like. I mean, for me, for example, I mean, 5 years down the road is something that is, oh, what's going to happen in 5 years really? Much less to say 20, 30 years down the road. So setting a goal, be it a very visual one or be it one that's on pen and paper, is going to help you psychologically. In terms of the math itself, we will go through the case studies later, and you can see that the math will work itself over time. Right. So for setting goals, I would like to say that, or rather, I would like to suggest there are two goals, or rather two factors that you can bear in mind when it comes to setting your retirement goal. One of which is actually the lifestyle that you would like to have when you are retired. Melvin touched a little bit about it earlier, and I'd like to just further supplement it by saying that if, let's say, you are looking to retire, for example, overseas, or you're looking to retire in Singapore, there are different cost expenses that come into play. Your lifestyle as well matters. Like, for example, would you want to have a Starbucks coffee every morning, every afternoon, or would you be happy with a 3-in-1 coffee that you make with hot water? Right? So all this come into play, right, when you're setting a retirement goal. Like, what kind of a lifestyle do you envision yourself enjoying when it comes to retirement? Right? And of course, also the age itself matters a lot. Like, do you want to retire at 55, at 65, start traveling around the world, exploring places that you have never been to? Or do you think that at 75, you're still going to be working because, let's say, you have a lot of dependents, you enjoy working as well, right? So the retirement age comes into play because the longer the stretch of time that you have for your investments to actually work, that's where you'll be financially more stable. And I think the worries that you have at 75, at 80 will definitely be lesser. I think I can say for everyone is that when you are age 75, you don't want to be worrying about, oh no, I have no money in the bank, or rather, oh no, I need to actually budget more next month because this month I spent a bit too much. I need to budget more next month. And then you start worrying about money again. Money is a means, it's not a goal, right? That's why I always like to tell my clients as well, right? So estimating retirement expenses, rule of thumb, 70% of the current income. So for example, if let's say you're drawing an income of 5,000 right now, you probably will need around 3,500 to enjoy a comparable standard of living, right? So of course the expenses, they have to come into play: food, clothing, housing, so on and so forth, right? And of course inflation is creeping upwards, so this one also will have to come into play as well. So here I have another poll, and I think it's going to be a very interesting poll. Vivian, if I can just, great, thanks a lot. All right, so over here in this poll, we're going to ask you guys what kind of lifestyle you want to lead when you retire, right? Very, I would say very general lifestyles. You don't really have to go into nitty gritty. So the first example, simple lifestyle, drinking coffee at a local coffee shop, playing mahjong. Second one is eating out on the weekends with family, driving your grandkids around. Right, this one I can personally attest to it. My parents do help me to drive my kids around. All right. Cafe meals, shopping all day, drinking Starbucks and mimosas. Right, and of course the second one, which is I would say a more data-driven question: how much funds do you think you need on a monthly basis? Right, and you'll be quite surprised at this. So I'll give you guys a few minutes, just fill out the poll, and then Vivian, I'll just take your cue when most of the participants have filled it up.
Meanwhile, Jason, like I have a question for you. Like, how much do you think you will need for a comfortable retirement per month?
Well, I think honestly, I would need around 4,000 to 5,000. Right, that's where I am. How about you, Melvin? How much do you think you need?
Surprisingly, like I would say for 5,000, it should be sufficient. Like I did some quick maths. Like I think at 65, what kind of needs do I have? Right? I think most of my expenses or like expenditure, like it's become like a force of habit. Like between like 55 to 65, really, you expect like my expenditure to go insane.
Agree. Yeah, that's right. Yeah, even for me as well, I expect like 65. Most of my spending areas would be roughly the same as well, because I think I'll be spending more on certain areas like food.
Or learn how to cook.
All right, the results are in, and it's pretty interesting. So a lot of our participants, 61% of them, they envision like eating out on the weekends, driving the grandkids around. Very, very typical of Singaporeans, in fact, I would say. Okay, and then for the next question, you're looking at, wow, Melvin is pretty in line with what we are as well, around 3,000 to 4, 4,000 to 5.
So
And
it's like
wow,
between 3 to 5,000.
that's right, that's right. Surprisingly, quarter of the response actually came in at below 3,000. Wow, that's quite good. Okay. Excuse me. Okay, so let's go on. So over here I have data, some very simple data that actually shows household expenditure by different age groups itself. So you talk about like below 30, you talk about 30 to 39, 40 to 49, 50 to 59, and then 60 and above, right? And I've actually circled out three areas where 60 and above actually spend more. So what this means is that when they get older, they spend more in this category, and it's housing related, food, and health. So health, I think, Melvin, we didn't actually mention about health as well, but food-wise, yes, you mentioned you're cooking, so that one aside, right? But I think in terms of when people retire, these are actually the three areas that they actually tend to spend a bit more, right? Um, so the budgeting itself comes into play where it is good to actually sit down and to be able to understand in terms of your current spending needs, right? What are the different areas, what are the different aspects that you think that, okay, I'm spending, for example, on food right now, I'm spending 500 a month. When I retire, am I going to be spending more, right? We need to take into account inflation as well. Plate of chicken rice now is $4. Who knows, it could be like $7, $8 in future, right?
Exactly. And I think there's the thing about housing, right? It's that most of us, like in our more advanced years, right? Some of us actually take on the extra responsibility, for example, to like help our kids pay for housing renovation first, right? We might become that interest-free loan when our kids take.
Yeah, I agree. Definitely, yes. Yes. Right. So I think actually a personal anecdote that I have here is one of the I know a couple. So the wife is actually an accountant, and she absolutely dreads talking about household expenditure. And to her, it's more like, look, I'm spending 12 hours in the office, right? I'm actually doing the books there. So why do you want me to come home and do the exact same thing? I want to sit down and relax when I'm at home, right? And I totally get that. I totally understand that feeling where you want to actually unwind after your work. And honestly, it doesn't need to be that difficult, right? Sit down, look at it in a very long and torturous process, a 2-hour session every month. It doesn't need to be like that. So it could be as simple, or retirement planning could be as simple as, just setting up a joint account for the household expenses, right? And then whatever there's left in that account, spend it on whatever wants that you have. Go to a restaurant, have a nice meal, right? And a separate account could be used for actually your investments. So it can even be automated right now with today's technology. And I think that is simply seamless and easy, I would say efficient even, right? Rather than imagining spending that 2-3 hours sitting at the dining table with all your paper bills and then working out, okay, how much do we exactly need? It doesn't need to be that torturous. And over here, I think we have an example of, let's say, a basic retirement expenses itself. So based on 2005, right? You can see the different breakdowns of this example. So 1,000 into food, 500 into utilities, 400 into transport, 600 into entertainment, right? And actually, this is CNA has actually done a survey. So a lot of Singaporeans believe that they need around 2,900 to 3,500 per month for a comfortable retirement. And again, I think here it's good to point out that different people have different expectations, and there's nothing right or wrong. If, for example, you think that you need 4,000 to 5,000 per month when you are retired, I don't think there's anything wrong. On the flip side, if let's say you're budgeting for 2,500 and then you're looking at another couple who's budgeting for 4 to 5, I don't think grass is necessarily greener on the other side in this particular aspect. I think what matters most is in terms of the balance, like whether are you comfortable with that standard of living that you can get with your monthly expense, or rather your monthly budget, right? And being able to stretch out that dollar to try and invest in the longer term, so that you're, in terms of finances wise, you are more stable. I think that one is actually more important when it comes to budgeting for your retirement expenses itself, right? Excuse me. So I think the next topic that we have is CPF Life. And I think for Singaporeans especially, this is a topic that definitely has to be raised when we're talking about retirement. Don't you agree, Melvin?
Exactly, exactly. I think it's something that most Singaporeans have they're just resigned to, like, oh, this is unavoidable, just give my money to CPF. But I think it's important that we still discuss CPF. Like, I think, especially for the younger participants today, I think it's good to gain some clarity on it. And, in some circumstances whereby your family or your parents are still not sure, maybe it's good to raise the topic with them and educate them as well on the changes. Yeah, over to you.
Yeah, agree, definitely agree. Right, so without further ado, let's go into the CPF. Right, and today's don't get us wrong. Today we're not going into the nitty-gritty details of the CPF Life, what's it about, so on and so forth. But rather, we're going to have a very general overview and seeing how CPF can actually come into play when we actually do our retirement planning itself. Right, so a few facts about CPF itself. At 55 years old, your OA, ordinary account, and your SA, special accounts, they are transferred over to your retirement account, RA, right, at age 55. And that's where you decide how much you want to actually transfer in. Like, are you looking at a basic retirement sum, full retirement sum, or enhanced retirement sum? All right. And thereafter, you'll be automatically enrolled into CPF Life itself. And there are actually 3 payout plans under CPF Life: standard, basic, and escalating plan. And I think in the next slide, so before I go on about the 3 different plans itself, maybe one thing to highlight is general consensus is that I know there are comments out there that saying that, okay, CPF is very obscure, it's not transparent. I don't know exactly how much am I going to get. The government is trying to eat my money. I think that's the phrase that a lot of layman people use as well. So I think CPF actually has done quite a good job trying to revamp that mentality itself. And if you go onto the website, you can actually see a calculator online. And that's where you can start to input details like your age, what year were you born in, right? And what's the retirement amount that you're going to put in. And that's where they start to calculate in terms of standard, escalating, or basic plan. How much will you actually get in per month basis? Right, so just a very brief overview. Standard, obviously, you are looking at a higher monthly payout, but a lower bequest to your beneficiaries. Right, basic, of course, you have more for your loved one, right, but you have a lower monthly payout. And then you have escalating, which is, it starts with lower monthly payouts, but it gradually increases by 2% per year. Right, and the 2% per year, how they come about with it is in terms of the inflation rate. They're looking at 2% per year. So this is a chart to show you the 3 different payout plans itself, right? So red is standard, blue is basic, and then the green is escalating, right? So obviously, if you see the escalating, it will actually rise over time. Whereas for the red and for the standard and the basic, you're pretty flat over the years itself. Right, so we take a screenshot at age 77, right? And we work out in terms of the basic monthly expense. Let's say you're talking about 2005. Right? Of course, this is not adjusted for inflation, right? And you take the life CPF Life Standard Plan 1005. I think inevitably you'll see that there is still a shortfall, right? Around 962 based on these calculations. Right? And so if you want to retire comfortably, I think the message here is that we will need to do more than just relying on CPF Life payout for our retirement planning, right? It is good, definitely, right? But we will need to do more than just CPF Life for a comfortable retirement itself. Right, and over here, I think we're going to look at 3 case studies. I'll hand it over to Melvin. He'll bring us through the 3 different case studies. And I think we can actually see in terms of personal situation, how can it actually apply to us? Right, Melvin, over to you.
All right, thank you, Jason. So to begin with, next slide. Singaporeans' average retirement bucket consists of like a typical short-term, mid-term, and long-term allocation, right? So short-term typically is your cash in bank, otherwise more liquid investments. Then of course your mid-term will be more of a balanced allocation whereby you're not taking like superseded risk. You're taking more of a balanced, more moderate risk approach whereby you're exposed to diversified holdings or sectors and asset class as well. Right, and for equities, of course, if you go on to the next slide, Jason, right, you guys can see that for long-term equities exposure is focused on outperformance, right, with targeted exposures towards high growth sectors. Typically, it will maximize your long-term growth potential, because this is where you need to understand something about retirement planning, right? Retirement planning will be one of the longest plan that you ever involve yourself in, right? From now till your eventual retirement at 65, right? That is not the end, because you have to account into your longevity, right? Post 65 until your eventual touchwood demise, right? It will come. Unfortunately, this is a reality that we all exist by, right? So it's going to be one of the longest thing that you ever planned for. So it's important to actually be well diversified, and the whole plan is to, of course, shelter you from the shocks, which Jason touched on as well, right? If there's any short-term shocks, right, bucket one caters to it, right? In a mid-term, between that 5 to 7 years, right, you have bucket two that will hopefully prevent you from touching bucket three, right? We're not saying that you don't take profit, I think it's good to reap some rewards, especially from a long-term plan you can, but definitely start from the short-term bucket first, right? That's the most reliable place whereby you can withdraw your funds from, right? Next slide, Jason. Right, so the first example here is Melissa. So the age is something close to heart for myself and Jason. And it's also, most of the clients here at Syfe ranges from like early 20s to like early 30s as well, right? So a typical take-home salary of Melissa is about 5.5K a month. Her current financial obligations is an existing home loan, a shared car expense with her husband, and also one child of about 6 years old, right? So for her ability to invest, right, unfortunately, no lump sum due to low cash in bank. So she's a client that after talking to her, we understand that, hey, you gotta have your emergency funds. This is not something that we compromise on. If you do not have your emergency funds, you do not even start investing. So after accounting for her emergency funds, we realized that the monthly budget is only about 1.5K a month to invest, right? So no lump sum. And for her investment goals, right, she has two, right? Children's education fund. So of the 1.5K, about 500 goes into it. But we're not here to discuss the education investment. So for her retirement goal, right, which she can allocate about $1,000 to. Jason, next slide. Right, you can see Melissa's portfolio breakdown here of about 60% towards equities, about 3% towards REITs, and of course, an additional cash buffer of 10%, right? So for equities, you guys can see that there's an allocation towards equity 100, right? Disruptive tech of 5%, and environmental, social governance, and clean energy at a further 5%. So do bear in mind, this one is a $1,000 allocation monthly, right? And imagine that from 35 to 65, there's an extremely long time for our money to compound. And on the top right, you guys can see how it relates back to the core satellite strategy that we kind of espouse all the time, right? And from there, you can see the expected return of cash plus, of REITs, and her equities investment of about 1.2%, 6%, 8.5% respectively. And across the timeline, you guys can pay attention to the figures at 10 years and 30 years, right? She's saving well, she's investing well. She retains her bucket one for any short-term emergency that she might encounter from now until 65. And look at her bucket two and bucket three, right? She has accumulated just from those two buckets itself more than $1.3 million at 65, right? Is that not an achievement, right? Right. For the next example will be Lincoln at 45 years old, right? take-home salary of about 6.7K a month, current financial obligations, existing home loan, car expense, self-paying. So you guys can see that this is a bachelor, right? Not married, no children, with an ability to invest a lump sum of $300,000, which he has saved across the years and also in multiple investments, but looking to place it into a digital wealth manager like Syfe. Right, for his investment goals of retirement, same thing, we are planning for 65, but the next slide will show you guys how it looks like throughout the years as well, with an allocation towards 50% equities, 40% REITs, and 10% cash, right? So as you guys can see here, current age of 45, Lincoln, 10 years later at 55, he has already accumulated $500,000 just from a lump sum of 300K to begin with, right? And for another 10 years after that, right, you guys can see that Lincoln is at $1.1 million, right? So top right, same thing. You guys can see how it relates back to our core satellite strategy, right? Do note that this is a plan for more than 10 years. This is why the client can expect to take a bit more risk as well. And this is on the assumption and the checks that we do to ensure that the client has a sufficient emergency fund and also no short-term sectoral risk in his or her career, right? This client, Lincoln, is not investing a monthly amount because of his high monthly expenditure. He is trying to use his lump sum saved, otherwise doing almost close to nothing in his bank. And for David, right, take home salary of about $11,600. David is at 55 years old. So David is the oldest example out of the 3 case studies, but he still has an existing home loan, right? A car expense that he is self-paying for. He also has 2 children, aged 25 and 22, right? Thankfully, David has already managed the education side for his 2 children, and therefore he has the ability to invest a lump sum of $250,000 and a monthly budget of $3,000. This $3,000 can be a combination of his and his wife's savings, right? And of course, it's for the investment goal of retirement. Next slide. Right, so for David's portfolio breakdown, right, same thing, allocated 10% towards cash plus. This is to account for any short-term needs for his money. And of course, a 45% allocation to both equities and REITs. But for equities, there's a distribution of a 30% for equity 100, 10% allocation to his own custom portfolio. So David is a very well-experienced investor. And the next satellite exposure is to ESG and clean energy at 5%. Right, so you guys can see the distribution here between a 10%, 45% allocation between the 3 portfolios. And in time, with a $3,000 monthly deposit, right, the forecast shows that in 10 years' time, right, David has also managed to squeeze in $1 million. Right? But from this example, what we are trying to convey to the participants today is that the $1 million might not be the goal that you guys have, but it's a very good starting goal for most. There's a strong movement out there called 1M65, mainly using CPF as well, but this is just to articulate your cash options here. Right, next slide, Jason. Right, so what happens at 65 and beyond? Because as I mentioned earlier, right, the plan doesn't stop at 65. In fact, 65 is a pivotal year if it's your retirement age. Therefore, we do something known as a de-risking strategy, right? From a 100% REIT allocation, a rebalancing can occur into a REITs with risk management, for example, which shelters you from further volatility from the REIT market due to the allocation towards bonds, right? And if you feel like there's a need for a core defensive portfolio, otherwise you can maintain a core growth, a core balanced portfolio as well, right? But it's definitely good to de-risk a little bit. In this example, we are showing a core defensive portfolio, which is largely a bond allocation portfolio, right? So with a 65% allocated towards REIT plus, 25% towards core defensive, this total allocation outlook here is a defensive allocation, right? So as you can see, the current age is 65, right? Starting at $1 million, right? You have accumulated $1 million at 65. 2 years later, with this allocation, you have about 1,081,000, right? But look at it through the years, at the 10-year mark, you have close to $1.5 million. But look at bucket 2. Bucket 2 is your REIT portfolio. The REIT portfolio delivers 4.5% in dividends, right? And if you look at the bottom part of the table, right, it will deliver about $35,000 to $43,000 in dividends per year. And even at 65, you are drawing about at least 2.4K more per month equivalent, right, from a dividend yield of 4.5% just from REITs, right? So this is just from REITs. And you notice that in bucket 1, you still retain a 100K allocation. This is more than sufficient to at least travel the world once. What do you think, Jason? Is it enough for you to take the dream vacation?
Yeah, definitely. I mean, I can be drinking Starbucks and mimosas every day.
All right, that's good to know. But of course, this allocation, is non-exhaustive. It's simply catered to most at 65. But if you find that you are more adventurous, you want to secure more of a legacy fund, you can plan for that as well at 65. Right, but this is solely just for yourself. If you take a look, if you have the design of it is that there's no need to touch on bucket 2 or bucket 3, just let grow. And even if you need to withdraw for some, spur of the moment needs, do touch on bucket 1 first, right? And then you can take profits from bucket 3 to push it back into bucket 2 or bucket 1 as well, right? So this is just an example of the bucket strategy while staying aligned to core satellite investing, right? Next slide, Jason. I think I can pass on to you.
Yes, so I think so after the 3 case studies, Melvin and I thought that it would be good to actually allocate just a quick 5 minutes for those of us who are perhaps new to Syfe, haven't actually looked at Syfe before. So to give a very brief introduction about Syfe, Syfe is a digital wealth advisory platform, right? And I think our main mission is to actually democratize investments and make it very seamless and very efficient. So if you refer to the earlier examples where I was talking about having to actually sit down 2-hour session every month, trying to decide like, hey, this funds go to this account, that funds going to this account, right? And then next month, do the same thing over again. And then the following month, do the same thing over again. And I think we would like to spend our time in a more fruitful manner, definitely. So for Syfe itself, because of the technology that we have, we make it in a very automated way where you just set it up once at the start. And we actually have curated portfolios that we can assist our clients to do so as well. So it becomes from a very manual process of investment and having to figure out what exactly are the single stock companies you should buy into, how to diversify your portfolio. We've actually done it all for you. We've done all the hard work and come up with the Syfe Wealth platform, right? So a little bit before I explain more on our products, is safety is our #1 priority here at Syfe. We are actually regulated by the MAS, and we're actually under the CMS license, Capital Market Services. Right, and what this means for our clients is that in terms of the funds wise, we make it very clear between our client assets, our client funds, and Syfe's own funds itself. So for our clients' funds, talk about the cash assets, they're actually held in a separate trust account under DBS and HSBC, right? And for invested assets, they are actually held under Saxo, Citi, and HSBC. Right, so I think if you are an investor, perhaps one of the pertinent questions you might have is, what happens if, worst thing happen, God forbid, Syfe closes down? And I think this is where you can actually see in terms of the checks and balances that we have here at Syfe, it is definitely towards the investor's benefit itself. Right? So this is the suite of products that we have. Definitely, we are actually increasing the number of products that we have on a day, on a very frequent basis, right? So you look at the core satellite strategy that Melvin actually talked about earlier. Right, under the core portfolio, we actually have 4 different portfolios. Talk about like equity 100, growth, balance, defensive. And we've actually curated these portfolios to actually return the best risk-adjusted returns for the client himself. Right? If you look at the right-hand side of the screen, you can see that the risk levels, we've also put it beside the portfolio. So when you're investing in the equity 100 portfolio, for example, the investor who invests in it, they know, okay, this is a level 4 risk portfolio, right? So I go in with that expectation. And if I'm not ready for that level of risk, then perhaps I want to go for a level 1 portfolio, a more defensive one, which is the core defensive portfolio itself, right? Under the satellite portion, we have the REIT Plus, we have the thematic portfolios as well. So thematic portfolios, I think Melvin also mentioned about it earlier, where you have like ESG and clean energy, you have like disruptive technology, blockchain, for example, there's a blockchain ETF within this portfolio. Or let's say you have a very strong belief into the China growth market, the China market itself. So there is actually the China growth portfolio. So these are curated portfolios that our investors can actually invest in without having to select each and every single stocks or ETFs itself, right? We have the custom portfolio builder, and I think this one is actually a very strong feature on the Syfe platform. So this is, I would say, a little bit for advanced investors who already know what ETFs they want to actually invest in, and that's where they can build their own customized portfolio. So 20% into this ETF, 20% into that ETF, and you can do up to 8 ETFs itself, right? So I think this is definitely a very useful feature, because instead of having to send money to 8 different locations, all I need to do is to just consolidate into one single portfolio and I'm done, right? We also have the Cash Plus. It's a very good cash management solution for clients, very defensive in nature, 1.2% per annum, which is definitely better than a bank saving account, for example. And of course, we have the Syfe Trade platform, where we actually allow clients to select single stock companies, right? And there's fractional trading over there as well. So very quickly, fractional trading, essentially it breaks it down into a dollar amount. And I think this is definitely useful for customers who are looking to have a certain budget when it comes to investing. For example, I have $100 to buy Apple shares. Apple shares are like worth more than that, right? So this is where fractional trading comes into play. And the fees, of course, we work on a very simple fee model, assets under management. So we look at the total sum invested, right? We have 4 different tiers itself: blue, black, gold, and private wealth, right? And you can actually see in terms of the fees. So the fees wise, I would say pretty competitive throughout the market. And when it comes to the fee structure, we do not have any hidden charges. So talk about like trading fees, we don't have that. We don't have entry exit charges. The rebalancing of the portfolio is unlimited. You can do it as many times as you want. Of course, we don't suggest doing it every single day, right? And we actually do it automatically for you, in fact, right? Syfe actually rebalances our portfolio twice a year, right? There's unlimited free withdrawal of the funds as well, right? And I think the key thing over here is that when it comes to transparency, it is very transparent on the platform. The app, you download it on your mobile, you can access it anytime 24/7, and you can easily see how much holdings you have under your account, what are the fees that are being charged, what are the rebates that are being pushed back to your account as well. So very, very transparent. And if ever you have any questions, you can just let us know. We'll be very glad to follow it up with you also. Right. A little plug here on our next upcoming session. Right, I'm very excited to share with you guys that it's going to be a physical session, right? 19th of May, 7 to 8 p.m. Vivian, if you don't mind, could you just share the link in the chat itself, right, so that our investors can actually take a look at it, right? So this will be the first physical session that we're going to be holding. We're going to be talking about our philosophy when it comes to investment itself, right? And I think in the time of volatility, this is ever more so important, right? So a plug, next week, 19th of May, 7 to 8 p.m. Do join us. And of course, the advisory team, speak to a wealth expert if you have any doubts, any questions, right? So I think to bring this into the perspective of the client, a good perspective would be, what if I am stuck somewhere? What if I've sat down, I've thought it through, I think this is the best way. How do I know? How do I double check with someone? And I think, Melvin, definitely you can speak to your experiences with the investors, your own clients, how you have been able to help them, right?
Yes, so definitely do speak to us. We understand that if it's a webinar or a seminar, there's certain fears, like maybe there's a fear of asking stupid questions, but there's no such thing as stupid questions, right? If it's uncomfortable, do reach out to us. We're more than willing to help. And in this case, I think there's a clarification, right?
Oh yes,
the
that's right.
that is no longer a physical
Oh dear.
seminar, it will be a online one. So this is because we want to actually accommodate more people,
Mm.
and due to the overwhelming response. So unfortunately, the physical location won't be possible, but
I see, I see.
we do look forward to meeting all of you all soon, hopefully, physically, right?
Yes, yes.
And I think for now, let's take some questions. I think we have time for about 3 or 4.
Yes.
Right? So we'll leave the 6 months management fee waiver promo code on the screen while we take some questions. Jason, sound good?
Yeah, definitely, definitely.
Right.
And I think,
So the first one I think that we should actually address is from an anonymous attendee, right? He has some SGX stocks. Do we bring that in when allocating? I think it really depends on how you look at it, right? For this allocation, it's for funds winning Syfe that the clients have entrusted us with, right? But broad-based, if you talk about your own stocks, I would say you should manage them yourself, and do bear in mind that you are not taking on excessive risk closer towards your retirement, right? The same stocks might not make sense. So for example, if you're gonna chase some growth stock when you're young, right? When you inch closer towards your retirement, maybe it's best that you start looking more towards like your blue chips, much more stable companies, right?
yes, I mean,
And
if I can just chime in over here, I definitely
sure,
agree with what you mentioned with regards to looking at some blue chip stocks. I think the general idea is to actually decrease the level of volatility in your portfolio as you grow more and more mature. And because ultimately you don't want to be in for a roller coaster ride at 65 years old, right?
exactly.
Mm.
So another good question, right, from Kenneth, right? He is currently in his 20s, and some of his friends around him are aiming to hit their first million in their 30s. Do you think this is achievable? How relevant will 1M65 or 4M65 be then? I I think the privilege of working here at Syfe is that we deal with clients from all walks of life. I think we have been seeing some really, really successful DIY investors, right? Some in their 30s, they have accomplished more than $1 million just from investment. Maybe on our view is that maybe the investments are on a more speculative, uh, much more unregulated sector, right? But still, it's no easy mean. And we do hope that every client of ours does well in their own investment as well. Because as much as we are talking about size products, I think it definitely makes sense to learn a bit more about the financial markets, what's out there, and of course to do your own investments on the side as well, right? And will 1M65 or 4M65 be relevant? Of course, it stays relevant, right? Because if you think about it, 20s to your 30s, right? It's a short 10 over years, right? Your success then might not be replicated past 40s or 50s, right? Feels like you accomplish everything that you need to achieve in the first 20 years. But the financial markets can change dramatically and your trades can go against you, right? In your 50s or 60s. So I think it's still important, right? To take a look at your investments much more, carefully, right? Do remember you can de-risk over time. And maybe one question for you, Jason, right? What's the average dividend payout for the core portfolios?
So I think for the core portfolios itself, we have to look at the breakdown of the individual ETFs itself. Of course, this differs depending on the portfolio. Talk about, for example, equity 100, where there is a lot of equity, 100% equities itself. The payout will definitely be higher compared to, say, a core defensive portfolio. Right. So for core portfolios, typically we don't look at dividend payouts, but rather we look at in terms of the growth returns of the portfolio. For a typical dividend portfolio, I think we can look at REIT Plus. REIT Plus has a pretty steady passive dividend yield itself, and it's been pretty consistent thus far. Talk about around 5.5% in 2022 so far. I think that's pretty good. Right. So that's just a very quick answer to that question. And I think another question that I thought was quite interesting also, it was also asked by an anonymous attendee, is why is the ESG exposure so little in our portfolio planning itself? And I think over here, ESG actually comes under what we see as the satellite aspect. And it could actually vary from investor to investor. So depending on your core belief, whether or not you wish to actually increase your exposure to ESG, or whether you actually like to allocate more funds towards, say, China growth or disruptive technology. So this one takes into account the individual investors' preferences as well, because we know that not every single, no one single portfolio can cater to all the investors. That is definitely impossible, right? So depending on the preference of the individual investors, right, we can definitely look to allocate a little bit more towards ESG or disruptive tech, depending on your personal beliefs as well.
Good answer, Jason. So I think the last question, right? With the volatile markets these days, should rebalancing be done quarterly? I think by and large, we design the portfolios to be rebalanced on some like a twice a year basis. This is because we don't want to come across as a fund manager that's overly reactive to the markets, because most often than not, right, we make the choice selection of the securities that we want for the portfolio because these are long-term, benefits and rewards that we expect to reap from them. And any short-term movements in the market do not diminish their long-term value to us, right? Any rebalancing that we do, they are akin to the factor-based strategy, the smart beta strategy that we use. So if there's any factor regression, then of course we will rebalance the portfolio, but no more than twice a year at this instance.
So Melvin, maybe one last question, perhaps some of our participants might want to ask also is, if let's say they have any questions, how can they reach out to us?
Okay, so we are definitely available to connect over the phone, over a video conversation. You can actually head to this link that Vivian can drop into the chat. Feel free to book a call at your convenience. Otherwise, you can write into our email and we'll get back to you as soon as we can for a phone call or even a WhatsApp conversation if it's required. And I believe this is all the time that we have for today. Hope to see you for our online webinar soon. So,
all right. Thanks. Thank you, everyone. Thank you for your time.